with this situation we're in, like I said, we're on uncharted waters. I guess the big thing here is that we've had just an influx of interest rates, where they've been up and they've been down, and I know that the question is where are they going and what's happening, and I was hoping maybe you can give us some insights to what's happening there.
Yes. A few weeks back, we were in all-time lowest rates as far as interest rate environment is concerned. And then what happened is the CARE Act got passed. And every time there's something that happens within Congress, they have good intentions, but there's always unintended consequences. So what we saw with the CARE Act, what happened with that is they're really trying hard to buy down mortgage-backed securities, okay? Because they want to lower interest rates, but they didn't understand how the whole market works. So when you're trying to buy, what the government did is they stepped in and bought mortgage-backed securities in the hope that they could drive down interest rates. But what they forgot about is the fact that every time you're a mortgage company, when you have a mortgage out there that's locked, you have to hedge that mortgage in the marketplace. So the company has to put a certain percentage, usually between 1% and 5% of that mortgage amount, and they have to put that up as cash. So when the government went in and tried to buy down the interest rates to make them even better, what ended up happening is they went the opposite direction. And because of that cash that was required, companies all of a sudden had to start writing checks. We wrote several checks, hundreds of millions of dollars in checks that went out to the warehouse lines. And so unintended consequences is it drove up the interest rates. The other thing that happened too is the government came out and they wanted to help, and they wanted to offer the forbearance plans. Well, if you're a mortgage servicer and your servicing portfolio is given the opportunity to not have to pay for their mortgage for 12 months,
Yeah.
the servicing company still has to make those payments. That's in their contract to the investors that buy those mortgages. So the problem is it puts the servicers in a horrible position where they have to pay for those mortgages. So again, good for the consumer in that they get a break on their mortgage payments while we're going through this difficult time.
Right.
But they didn't think the whole thing through. Now there is going to be some things that are going to happen in the next 2 weeks that I think we'll see some servicing, we'll see the liquidity help. They're putting some things in place. I just watched an interview with Dave Stevens, who used to head up the MBA Mortgage Bankers Association. And so they're putting things in place, the government is, they're aware of the problem, they're going to fix it, okay? And what that will inevitably do is it will drive down mortgage rates again. So like right now,
we're looking at potential lower interest rates than we currently have.
I think we're going to see lower rates than we've ever had before.
Hypothetically, oh really? Okay.
I think if it was good if you took advantage of it a few weeks back.
Right.
But definitely now don't feel like you've missed out, because they're going to come back, and the government and the Fed is going to do everything they can to make mortgage rates lower as we come out of this. This is temporary. The virus, it's a virus. It's not like the recession was last time. Okay?
Right.
It's going to be a dip, and then it's going to come back.
Yeah.
And when it comes back, there's going to be pent-up demand, and the government, housing is one of the hugest drivers in our economy right now.
Yeah, so a huge aspect of our GDP.
Absolutely. So they're going to do everything they can to keep rates low. And there's already pent-up demand, and there was not enough supply. So I would say if you're sitting on the sidelines right now, this is a great time to buy, to get in.
Yeah.
And again, if you can be a little patient with the interest rates, they will come back, and we will see better rates than we have right now.
Even if someone needed to buy today, I mean, in the respect of, there's some people that they have to move, they have to relocate,
yes,
whatever. It's still at this point. I mean, just with today's rates, this still is record low.
It's phenomenal. I mean, you're still in the threes on a 30-year,
right.
So it's not like that's not like it's gonna be something that you're going to, I guess what I'm doing with a lot of my clients is if we're having to do something now, and we're having to lock right now, we're just making sure when we do lock and when we do structure that mortgage that we don't have a lot of upfront fees. So we're not paying points to buy down the rate.
Correct.
Okay, because we're going to have an opportunity to refinance it down the road. So why would you put a lot of money into this mortgage now? Yes, rates are great, but then down the road we will have an opportunity to refinance. So let's save some of that money that we were going to invest in the mortgage now. Let's invest in it later on to get you the all-time lowest rate possible. Okay. Right. Yes, they're great. They're phenomenal right now, but I do have a feeling they're going to get even better yet.
Well, and I think the other part of the reason I have a conversation with you, and we have a number of lenders we work with, but I know that the people that our clients who've worked with you have said nothing but great things in reference to
thank you.
That you work through all the different scenarios. Like, if you do this, the outcome is this, and and I think that's what people need. The more information that people have, it allows them to make an educated decision.
Absolutely, and people call in and they ask, well, what's your rate? If somebody quotes you a rate on the phone, run away as far as you can, because there are more than 20 factors that go into determining what your interest rate is.
It's not just about
so if
rates.
I'm quoting a rate,
Yeah.
I don't know anything about you,
Yeah.
and all I'm trying to do, I hate to say this, but it's kind of a bait and switch tactic where I'm trying to lead you in with, okay, you've got the all-time lowest rate. And then they get you in the office, they talk, and they say, wait a minute, I'm sorry, that's not what the rate is for you because your credit score is X, or
Right.
you don't have 25% down, so this. So, unfortunately, if you go based on rate alone, you're probably going to get burned. And
Right.
so that's not what the most important thing is. The other questions that people need to ask is, how long am I going to be in the home? What are my goals for it? And also looking at your other financial goals too. Not just what is my rate.
Right,
So, yeah.
right. Because a lot of times when people talk to me about, putting money down and that sort of thing, I said, talk to your lender, talk to your
Absolutely.
financial advisor, because you may have enough money to buy the house with cash, but my thing is, with the rates being what they are, maybe you don't want to do that, and maybe it'd be better to use that, use a mortgage for part of the home and take that cash and be able to utilize it for other investments.
Right. Going back to the all-time lowest rates, maybe you can invest that money somewhere else, or
Right.
pay down other obligations that you might have that have a higher interest rate.
Right.
Absolutely.
Okay. Well, I appreciate that in reference to to wrap this up, in reference to where the interest rates been, where they're going. If I understood you, just said we got a little volatility with the amount of demand, and then and the people being able to service the loans to a certain degree, so that's why the rates went up for a little bit.
That is the
Now
biggest
they've
thing.
started to come back down a little bit, but you're saying that these may even be lower than what we're seeing right now, and
Absolutely.
record lows. So that's the good news, the silver lining to part of this conversation, I think.
Right. It's a liquidity issue. And so once the servicing, because in the past, the servicing release premium, every mortgage loan had a certain premium that you get on the backside of the loan.
Mm-hmm.
We saw those drop from maybe around a 2.25% range to a 0.5 point. Okay. Now, if you're not in the mortgage industry, you probably don't know what that means. But at the end of the day, those people that service mortgages don't get as much money. And so why would they ever want to do that? Especially when you combine the risk of the fact that people are losing their jobs and won't make their payments.
Well, therein lies the
And so it's locked up right now, but it's gonna start flowing again, and things are gonna start. And again, some of those things they're putting in place will help tremendously. And then going back to it, it's gonna get a lot better.